Check out tradingequilibrium.com, a trading membership site for swing traders of all experience levels, offering educational posts and videos, daily actionable trade ideas, weekly market reviews, and a private Twitter feed with real-time trading. Welcome to Trading Equilibrium. This brief video focuses on entries and stops. It's the nuts and bolts of setting up any potential trade. So entries and stops go hand in hand, and both must be defined clearly before entering any trade. There are no exceptions. It's how you evaluate risk and reward and position sizing. Wider stops equals smaller position sizing, less favorable risk reward. Tighter stops equal larger position sizing and more favorable risk reward, but a higher chance of being stopped out. This is always the balancing act you're facing when determining entries and stops. In a broader sense, planning your entry and your exit is the act of you imposing your logic onto price action. Price action is beyond your control, but you want to trade in sync with the market. There are a million ways to trade, as you've heard, and planning entry and stop is your main way of imposing your logic on price action to set up a trade. For swing traders, we're imposing our logic onto a setup based on our time frame and our goals. Long-term investors, day traders have different time frames and goals. What we're looking for are moves that last days to weeks, so we set up our entry and our stop accordingly. The way I trade, my stops are inviolate. I never move them downward or cancel them. They only move upward as a trade goes in my favor. Stops are there to protect you and to define your risk. Undefined risk is gambling and the quickest way to damage your account. If you're serious about trading, you have to think of this as a business because that's what it is. Every trade you place and every risk you take is the price of doing business. But those must be calculated risks, just as in a traditional business. Think of insurance companies. They calculate risks meticulously. It's literally a mathematical process. They don't just collect premiums and hope insurance payouts are less than their premiums. They go in knowing to mathematical certainty what their risk is, what their exposure is. That's just sound logic, and it's what we're doing here. So there's also no single right way to enter. There can be several right ways to enter that lead to a profitable trade, but there must be a logic, an underpinning logic to both your entry and your stop. There is, however, a wrong way to enter. Placing stops at random levels because you decided you want to lose, you can only stand to lose XYZ percentage of money, and it doesn't correspond to support or any kind of technical level, that's not logical. That's random. Worse than that, not placing any stops at all. That's just gambling. At best, that's hoping. I want to place my stops at a point where the reason I've entered the trade is invalidated and then position size accordingly from that. So you set up your entry and your stop in logical places using your logical time horizon and you position size according to those levels. That being said, it can be more art than science, but there must be a logical underpinning. So the logic behind your stops also has to adjust to different market environments. Strong trending markets allow you to use tighter stops and anticipate moves, be more aggressive, changing your entry and your risk reward proposition. Choppy markets present different challenges. You either can use very wide stops to keep yourself in a trade longer should there be more movement. You try and participate in a reversal move with closely defined stops with a high risk reward ratio. Many of these different scenarios exist, and you want to align your entry and stop logic with the current market dynamic. These are all ideas we'll cover more in depth in the site. But understanding how to plan your entries and stops based on your desired logic is what helps you become a more confident, independent trader, and it opens up a world of possibilities. Okay, let's look at some real life examples. Let's take a look at NEO. This is a beautiful chart here, and I actually placed several trades on this name during this time frame. If you don't know this little feature on TradingView, it's very handy. You can do a replay going back to anywhere you'd like, which is interesting to recreate what was taking place in the moment. So let's go back here. I had actually placed a trade earlier in this sequence back here, and I may go through the trades I placed in NEO exactly on an anatomy of a trade video for the website. But for here, I just want to talk in broader terms about placing entries and stops. So we'll see where this setup, whether this kept going. But this obviously was, well, the setup here was this long channel with rising MAs below it. This bar broke to the high of that channel. We broke up above and then consolidated above that channel. So this looked like a very strong name. It had been consolidating and moving higher in big moves before. So this looked like a very strong setup, basing nicely up here, holding this break. That's what catches your eye. So around this day is when I placed another trade. It was around right here, looking at this setup, an inside day, etc. So let's say you're going to enter here. Let's say you're going to enter here. What's your reason for entering early? You could wait for a breakout, right? Again, it's your risk reward. If you enter early, you have a better risk reward proposition. Let's say you're going to put your stop. Where do you want to put your stop on something like this? I would argue that you logically want to put it below the lows of this consolidation pattern. So somewhere maybe right around here, give yourself a little buffer. Let's call it uh, let's call it 2040, just for the sake of round numbers. Let's say that's a reasonable place to put your stop, and you're going to enter here. Uh, and why do you want to enter here? You have a couple of choices, right? Um, the reason I entered here, and this is roughly where I entered, is because in the summer and in a very trending market, uptrending market in the summer, you were getting paid to take that risk of entering early, entering in anticipation of a breakout. You would actually do very well because there were a lot of gaps up in the morning. Things were moving to the upside quickly, and almost all breakout patterns were breaking to the upside. So you actually could take that risk and be aggressive. So this is imposing our logic on us. This is our choice to be aggressive if we take the entry here. We could wait to take the entry above here and get what you would call confirmation. But there is never such thing as perfect confirmation. So you're always making this choice. With this entry here and a stop below here, we're taking a relatively narrow um, risk position here so that we can expand our position sizing. Since the difference between our entry and our stop is relatively narrow, we can have a higher position size and a higher risk reward should this move up. It's also susceptible to fail, right? Because we're not taking it after it breaks out. This could just puddle along here and fail. Why do we have the stop over here? Because remember our time horizon here, we're swing traders. We want days to weeks. So I'm going to let this fall down, let's say the 50 day, and consolidate down here and come back up. Maybe spend a month, building a new base down here. That's not what I want to participate in at all. If you're an investor, maybe you do. As a swing trader, I want to be out of this if this doesn't move. So my stop is below the low of this consolidation. Because if this moves out of this consolidation pattern, I'm going to be longing. So that's the simple logic we're imposing on price action. You see the price action taking place, you're imposing your entry and your stop according to your logic to take a trade. So let's see how this plays out. The next couple days start unfolding. We're still within the range. Getting some tight candles on the 9 EMA, riding the 9 EMA up. It all looks good. Stop hasn't been hit. And then boom, there's the breakout. So let's see what happened here with the breakout. If we had been adopting the strategy of let's wait until price breaks above this level, you missed it. Gapped up well above that level. So what we did was we got in here around 2150, and we're able to ride that gap. So there's no guarantee that you're going to be able to buy at that level if that goes up. So that's being rewarded here for buying in anticipation and taking on that extra risk. So that's the calculation you're doing as a trader. This is what trading is. It's not about there's a simple rule book and a handbook that you follow. You can have a system that way. You can say, I'm only going to trade if it goes above this level. You can say, I'm only going to take anticipation trades. That's entirely up to you. I prefer to try to work with the market dynamics and try to read them. That's what I consider to be the fun of being being a trader. So in this instance, we took a relatively tight stop position here. We increased our risk a little bit by buying in advance of a breakout, but we also increased our risk reward proposition. And this continued to move. This was a real trade we took with these exact entries and stops, but it definitely took this trade. It's on Twitter. I sold half this day, sold another half this day, and I'm out. And that's exactly what you're looking for. Had this broken down, I want to be out. I don't want to sit around here and wait as it consolidates. So that's a look at imposing our underlying logic as a trader in terms of our time horizon, wanting to be in this for a move up and not a consolidation at a lower level. That's our time horizon, imposing this logic on it. And in this instance, I was entering in advance of in anticipation of a move rather than waiting for a breakout to occur. And those are your choices. You just simply have to weigh the calculated risk of each one. Let's take a look at another one. An actual trade that I placed too. This was a losing trade. Let's look at net. So when I took this trade, if I remember correctly, and again, this is not meant to document the trade, I just happen to remember it. This is meant to show the principles at work here. So when I took this trade, let's get this replay thing going. It was around here. So let's go back there. And at the time when you're looking at this, let's throw one more candle in here. At the time you're looking at this, um, it starts to look like a pattern's forming, right? But let's go back to the way it was. It looked like this to me at the time. So you're drawing lines as you do. Someone trying to figure out patterns. And here's the pattern we're looking at around here. And this is, I'm pretty sure this is where I entered. So let's assume this is. It doesn't matter if I did or not for the sake of this argument. So this, you could argue this is definitely a flag pattern, a bull flag. You call it a pennant. It doesn't really matter what you're calling it. It's a consolidation pattern after a big move. You could enter here. You could enter here on this break. You could say this is a break of this triangle. I think this is going to break upwards and start to move towards new highs. And that's a valid entry. And that's on your time frame. You're using a swing trader's time frame. You want to catch a move up to here. This is so making this trade conform to your logic, imposing your logic on this trade. Where do you want to be out? You want to be out below this consolidation level. So you can place a stop right here. That makes perfect sense. Let's call it 53.40. So if price moves below this level, you want to be out of this trade because you're looking for a short move up, a short and quick move up here. You're not looking to be in this and have it consolidate further along and tie up your money for 3 weeks. You're looking to have a quick trade. So we're in at this level. We've defined our position size and accordingly, and we're ready to go with our logic being imposed on this trade. Let's see how this plays out. Next couple days, it doesn't make the move up. In fact, it goes lower and we get stopped out. And this is essentially what happened to me. And then what we do later on is you start to see this is actually, a continued consolidation down, or we don't know yet. It may end up just actually breaking. But the idea is here at the given moment in time where we were taking this trade, we defined the risk we wanted to take with our entry and our stops and made it clear that we were not going to participate if price moved lower than this. And we decided we wanted to enter on what looked like a reversal. And it's as simple as that. You just have to be constantly calculating your position size accordingly and making these judgments according to your logic. Something that makes no sense is, I think this looks good. I'm not going to place a stop at all, or I'm going to have a stop, that maybe is 25% represents a 25% loss to my account. And I'm going to place it right here for no reason at all. There's no logical reason. This just represents a 25% loss to me. None of that makes any sense, right? So you want to impose your logic on trade. Now let's do one more really quickly. This is a trade I'm currently in. This happens to be election day 2020. So I'm doing this. The markets are open right now. Here's a trade I took. So let's look back to the day I took it. So here's the setup. Now this looks like your typical fantastic base setup. It's beautiful, what I'm always looking for. Took it before it started to make this break. So I had it in my head. I was going to take the trade around here. I didn't set a buy stop, so I got in around here. This is an open trade, so this is exactly where I got in, is 121.61, because that's the way I mark these charts. So the day this broke out is when I got in. So as this candle was moving up is when I got into the trade. Okay, I set my stop down here at 115.30 because to me, I wanted to give this a little bit of room. I wanted to let this play out because this has earnings coming up. That's the logic behind it. It could be a run to earnings. So I wanted to give this a little bit of room. Maybe it comes back, consolidates, and runs again. I want to give it a little bit of room on this one because this seemed like it could be a potential big mover. So calculate the risk, reward, position sizing. This is here because it looks to me as if there's some support around 117 level. So I put this a little bit lower than that. If price moves below this, I no longer want to be in this. Maybe it comes around, forms another handle. Doesn't matter. I'll look back on it when it does. But this is imposing my logic on this trade right now. My logic is I want to buy this breakout, and this is adjusting to the market too because we're in a much more volatile market now, and this name has not been the mover that Neo is. So what I'm trying to do here is actually wait for price to break in and take it at that point, which is what I did. And it's still reversed because it's been very volatile, but I'm not out yet. So we'll see where this went up until actual live intraday pricing right now. And what it's done is pull back. We've had a lot of volatility going into the election. This is pulling back relatively orderly. Today on election day, it moved up again, but it's still roughly in this range, and I'm still in this trade, and I'm fine with being in that trade. My logic still stands. So that's how you impose logic onto a trade and define your entries and your stops. Your entries are up to um, what you want to do, what you want to achieve with the trade, what your goals are. Are you trying to anticipate a breakout? Are you trying to catch a move once it happens so it's a little bit less risky? Those are up to you. And your position size is defined by where your stop is. But the key is that your stop is placed at a point that invalidates the reason for you entering a trade. Once price has invalidated the reason for you entering the trade, you should not want to be in it anymore. You can always revisit should it come back up. But take a look at my cliff dive, and you can see what happens if you disregard these stops or you cancel these stops. Price can fall much further than you ever anticipated and find yourself in a really bad situation. So I hope this has helped a little bit in terms of thinking about a logical framework for how you position yourself in terms of entries and stops, how critical they are, how important they are, how they frame your entire risk reward proposition, and how, in a broader sense, it's really imposing your logic on price action. It's where you, as a trader, get to impose your scenario, your logic on price action. All right, thank you very much, and we'll talk to you soon. Check out tradingequilibrium.com, a swing trading membership service designed to build independent, confident traders.